So that brings us to our price action lesson. This is an IPDA lesson. So again, this is kind of like high order charter member type level stuff. But I want to kind of like walk you through this, and I will teach more on this for actual charter members. But this is just to get everyone's gears going, because there's a lot of things that we haven't scratched the surface of yet. Okay. All right, so looking at the fractal here for euro dollars, our 15-minute time frame. This is obviously applicable to any time frame, but I'm going to work within the intraday model because, again, it offers you a lot of practice. You can go and look at a lot of examples and study, and what I'm showing you here, you'll find them in your own study. The grade level sell-side liquidity pool resting below these relative equal lows versus this red one here. This one's untapped, okay? It's unrealized. So the market has gone lower than this relative equal lows, and once this sell-side liquidity pool has been purged, okay, I want you to focus on what is one of the biggest retail traps there is, and I want to kind of like inject a interbank perception about the same things. So let's talk about the open float and layered liquidity. We have the old low here, and we have the old low here. Retail thought at this moment, when this low is taken out, when price trades back up to here, at this moment, if we were looking at price at that very minute, okay, retail, if we were able to poll them, okay, or go online and kind of get a sentiment reading on all the forums or all the social media posts about the euro dollar, they would be strongly supportive of looking for lower prices, and because broken support is going to be viewed as future resistance. Okay, support broken, now resistance. It's a common mantra in the retail universe, and that was something I believed when I first got involved in trading, and then I lost a lot of money and then no longer subscribed to that view. But at this moment here, I want you to look at this low here. The low is 111.57.2, okay, or 2 pipettes. We're going to look at this low in a moment with the actual level, but I want you to think about between this low and this low. That is old institutional order flow. Okay. Now again, what do I mean by that? There's order flow in the sense that it's price delivery, and we can track what side of the marketplace is being offered, and if we have a directional bias, which clearly is the sell side liquidity pool here in this example, if that's the case and we think that the euro dollar is going to go lower, retail is going to be looking for their setup at this low here, okay, or maybe at this low here, disregarding the wick. Maybe they just use the bodies of the candles, and that's fine. Okay, I understand why they would want to do that, but I want you to think differently. Okay, I want you to look at the top of that range between this low and this low. Now, before I go any further, if this low went lower than this low, we would still use these same reference points, just in the opposite. Okay, in other words, I'm looking at this high, this low, the higher one of the two, and this low. In this area here is old institutional order flow. That means orders were paired in this area, okay? Price ran aggressively down to get the orders that rested below these lows, but also orders were offered in the form of commerce, okay, in this area. So this is old institutional order flow. 10 pips exactly above that 111.57 and 2 pipettes takes us up to a 10 pip grade layered liquidity to 111.67 and 2 pipettes. Looking at the low here, on this, the lower of the two, 111.52 and 5 pipettes. 10 pips exactly above that takes us to 111.62 and 5 pipettes. Now, if we take both of those levels, okay, and overlay them on our chart, this is both of those two levels, 111.67.2, which is 10 pips above this low here. If we take a look at both those levels, 111.67.2 is 10 pips above this low here, and 10 pips above this low here takes us to 111.62 and a half. In this range, okay, this is a specific layered liquidity demarker. In this range, okay, what we're looking for is a specific IPDA PD array. So I'm going to ask you, looking at that, what resides inside this range? Inside of this range, you have a SIBI, sell-side imbalance, buy-side inefficiency. That's this right here in the form of a fair value gap. That's not the only PD array. You have a mitigation block, which is this down closed candle. This down closed candle and the fair value gap, both of them are overlapping and converging right there. Retail is expecting price to find resistance here and go lower. Maybe it's a bear flag. They're looking at that thinking, okay, this is a obvious bear flag. It's going to go lower. And the old low here would be a target of 1, and then they would do a flagpole low to high here, this range, projected from this high down, and they would get some level of downside projection for that supposed, smart money continuation pattern. Again, I'm trying to teach you the higher order of price action, okay? And I don't want you to fall in trap of retail like I did many, many times. I want you to look at price like this. The interbank perspective is going up to the top of that fair value gap and mitigation. So retail was thinking at this moment here, it's going to go lower. And then the interbank jams it all the way up into an area of rebalancing, fair value gap, and mitigation. It's also inside of this range in here. So we have all of the order flow that was inside this range here. There's an opportunity to go back in there and mitigate some of those longs that they had on that they couldn't get off. Fair value, which is a deferred rebalance. And then we had the mitigation, which is flipping orders that are underwater all through here. So retail versus interbank, this is the difference. And what's actually happening here is the open float. Open float is the orders when price was sitting at this level here. The orders above that, okay, is the buy side open float. The orders that are below this point here, like this low here and this low here, are the sell side open float. So whenever I talk about buy side and sell side, I'm specifically teaching you, without saying it, open float. That's the orders that are out there pending. The open interest that's in the marketplace in the form of positions that are active and being protected by stops, or pending orders that would instigate a new position entry. Open float is now pairing orders. So the market runs up, smart money sells at these levels because the orders that would be residing here are being paired together. So the market sees this run up. Anyone that sold short at the bear flag supposed idea and trusted the idea of selling short here or here, their stop loss would be above this swing high here. Boom. Or if they use this low here, their stop has to be just above that low. Well, they hit that too. And then, only then, the sell side liquidity is attacked here. So when we look at price, and to kind of like quote my son, he goes, Dad, I see the fair value gaps when you point them out, but I don't know when they're going to form and which ones to look at. That's where time of day, day of week, and institutional order flow overlap and converge to give you those specific levels and PD arrays. The market running up into this area here, it may not be the time of day that you feel comfortable trading, but you have to look at the economic calendar. You have to look at the daily profile, the weekly profile, the day of the week, time of day, and what the sentiment is. Okay? I'm drawing your attention back to this level here because all of this, think of this whole range, if you were to divide that in half, okay, and think that was like a key level, we'll call it that, a key specific key level. If that was a key level, by definition of anybody's view, whether it be Elliott Wave, supply and demand, classic support and resistance, whatever, everyone sees these levels on their chart, but everyone doesn't always have the same idea on what to do with it. And what I'm teaching you is to cancel out all of these supposed ideas and thought processes that permeate the retail universe and are traps. I want you to think about how this area here is the bulk of where the order flow is, because it's old order flow. But the market has to get to some level of a premium in an ideal scenario for the banks to pair their order with to go short. So before this low is taken out, when the market's trading down here like this, it could have very easily went lower. But I'm giving you an example of when price comes back to that old low. I want you to go into the marketplace and look at different pairs, different markets, different asset classes, and study this very event here. Because what I'm showing you here is a very high order way of looking at institutional order flow, tape reading, and finding setups and forecasting. Now, with that said, what we're comparing is the relationship between an interbank perspective, which is looking for a short up here, versus a short up, down here, back at these old lows. Retail's thinking here, we're thinking here. When we see this run up aggressively, we're not excited about that, thinking it's going to go higher. That's reasonable. We expect that to take place. And look at the measure of precision using these old markers here. And you're going to tell me who's going to argue with me. Okay, who's going to be the first guy in here or gal to argue and say that this is completely random how it went up here and reacted to these levels? Look at the highs in here. Okay, look at the highs respecting that bottom of that range, which is the projection from this low 10 pips up exactly. Obviously, when you go into higher time frames, you're going to look at a larger degree of layered liquidity demarkers. You'll use 15 and 20, 25, 30, but they go as far as 50 pips, and then it's no longer a layered liquidity concept. You're going to be looking at other things I haven't taught yet, but nonetheless, and whatever you guys can do to help me keep that time moving along, the better it'll be for all of us. So, but look at the difference between the perception of price being a bearish idea here at this point right here, where retail will see that as support broken, now resistance. Then you see this big run up here. They're running aggressively to fill in the imbalance here, go back to mitigation, because all of this area in here that they ramped up, they have to get the remaining orders off there. And there's open float, and it's also combined with layered liquidity demarkers. And then later on, you can see that the market does in fact move lower, attacking the sell side liquidity in the form of 20 pip grade layered liquidity, reaching down, which is, all this is what you're used to hearing me talk about. 5 pip, 10 pip, 15 pip, 20 pip, 25, 30 pip grade sweeps below old lows or above old highs. This idea here, okay, is something that you won't see that in anything. Okay, there's nothing like it, and it's part of IPDA. The interbank price delivery algorithm works at specific signatures in price, and it does so with a specific macro. In other words, a macro is a short list of instructions that it's supposed to do and follow and refer to. And the input that it uses is what I just showed you here, this low and this low here. And when price goes up into it, once you see this kind of stuff, if you were ever on the fence about is the market rigged, is the market controlled, believe me, this is absolutely nothing. This is nothing still. We're not even in the good stuff yet. But this is the type of thing that separates me from everyone else out there. And when I say that, I know some of you are thinking, oh, but you're not teaching everything. Folks, listen, look, if you're not impressed by these types of precision, seriously, like I literally could stop and never teach anything new. Just give you trading plans with everything I already taught, and you would be destroying everything in the form of competition out there. There would be no competition. There's simply nothing like this. It's not going to stop working because it works because of the size, the volume. All these things, okay, are created to facilitate large volume trading. That's institutional trading, not mom and pop trading, not retail trading and somebody running a service like myself, okay? People that you're never going to meet, okay, in the back rooms of high level institutions. I'm talking big wig folks that you're never going to meet. You're never going to meet them. They're not going to be on social media. They're not going to be on Instagram. They're not going to write books for you. Oh, XYZ traders giving all the secrets out. It's not going to exist. It's not meant for that. It would not be meant for that, okay? The goal was to help you sit down and learn to read the tape, okay? Reading the tape is reading the next few ticks and where is it drawing to. That's what tape reading is. And when you see that on 1 and 5 minute, 15 minute time frames, a large sample size of that, it's going to only improve your understanding. So I think I've jawboned enough for this midweek review. I want you to take what I've talked about here for open float and layered liquidity and the demarkers that I showed you here. When we see this framework, when we're expecting the market to run into a low resistance liquidity run, which is the run below this low here, if that is the setup and we have a low above this targeted low, you want to use this idea that I just taught here, okay, and study the examples that you find in price action. You want to look at 15-minute time frames as your lowest one, because 5 and 1 minutes gets a little bit more trickier and it's not as definitive as a 15 or a 1 hour chart. You can do a 30-minute chart. I've seen some real nice examples of over the years using that as well. But like I said, 15-minute is like my bellwether. This is the go-to chart for me for like entry setups. And if I really want to fine tune it, I drop it down to a 5-minute and 1 minute chart. You can get all kinds of setups on a 15-minute chart using a 1 hour and 4 hour bias. Okay, so whatever the market's likely to do based on your 4 hour or 1 hour, use a 15-minute time frame, use this criteria. And everything I said here, reverse it for bullish scenarios. So if this was reversed and this was like running this high here, you would take all this information on old highs instead of old lows and project it. Just everything I said here, you would flip it and apply it to what would be seen as a buying opportunity, okay, or old highs.